The markets are burning down, on fire, and will the Fed come and extinguish the flames? Well, it's probably not an exaggeration to look at the Fed as the arsonist. As they increase the money supply, we have the booms, and when they pull the money supply back, the markets burn down, and of course we have the busts. They have been the arsonists. So will they come with the fire hoses and put the markets out and push us back into a boom? And if so, when? What's going to happen? Well, we're going to look at that in this video right now. We're going to cover where we're at with the crash. What does the markets burning down really look like? We're going to look at when the Fed might actually come and pivot. Are they lying to us or gaslighting us? Are they really going into quantitative tightening like they said they were going to? We're going to look at why the traditional hedges, the safety hedges, are failing. And of course, we're going to look at how much further the markets could crash before something breaks and what you should be doing about it. That and more. So let's go ahead and just jump right in. All right. So the markets are burning down. The people we're hoping that will come extinguish the flames, the Federal Reserve, the Central Bank of the United States, of course, are the arsonists as they increase the money supply and shrink the money supply. So first thing, let's look at what the markets burning down actually look like. So as you can see here on my screen right now, this is a chart of the NASDAQ. The NASDAQ index is the one that holds most of the tech stocks. It's been extremely volatile. Over half of the stocks in the NASDAQ are down by more than 50% or more. Many of the darlings, the Squares, the Pelotons, Shopify's, they're down 70, 80, and even more than that. But as you can see right here, we are down about 35% in the market. Now, to put this into some sort of relative term for you, typically a bear market is when the market drops by 20% or more. Now, that's not like a hard and fast number, but that's about the typical rule. So about 20%, which you can see this green line that I've put on the screen right here. And we are at 35%, so we are well below that number. Now, to put this into some relation to see how bad this is, you can see back here, this other one, it's at a 40% drop. Of course, that was at March 2020 when the entire world was locked down. Everything was shut down. So you would expect it to drop pretty bad and pretty fast, which it did. It dropped to 40%. So we're not quite to 40, but we're at 35. It's pretty extreme. If we go back and look, this is a weekly chart. So we have to go all the way back here to 2012 to even 2011, really, to find another one that dropped about 30%, 31. So not even as bad as what we have. We have to go all the way back to basically 2008, the great financial crash, the global financial crash, to see, and of course here it plunged 70%. So that was the great financial crash, of course, the great plunge. But as you can see historically, it's a pretty big drop. Now, this is the NASDAQ, of course, the tech stock that's more volatile. What about the S&P 500? Well, as you can see on the screen, this is a chart, and it is a sea of red. Basically, every company in the S&P 500 is red today. So I call it a fire. You can say the markets are bleeding, whatever you want to call it, but it is panic in the street. So now what is going to happen? Everybody is looking at the Fed. Now, when we used to look at financial markets, we would look at companies, we'd look at PE ratios, we'd look at earnings, we'd look at things like that. Balance sheets, economic indicators, things like that. But today, unfortunately, we look at the politics because the politics is what's driving the market. And so now we're political analysts instead of market analysts. But as you can see right here, and as I've been talking about for years, Powell is facing a choice between elevated U.S. inflation and recession. Now, I said years. I've probably been talking about it for about 2 years, where the Fed is stuck. The Fed is stuck between a rock and a hard place. What do they do? And this kind of pins it here. Can they save inflation? Can they keep prices from going so crazy without putting us into a recession? You hear us talk about the Fed and a soft landing. Can they get us onto a soft landing? Well, I can tell you that in all the times that the Fed has reversed course, instead of putting money into the market and lowering rates, they decide to suck the money out by raising rates. Every time they've done that, they've, of course, always hoped to get a soft landing. And of all the times they've tried, one time they managed to get a soft landing. But where they're at right now, it's more like trying to take a plane and not land it on the runway. It's more like trying to not even land it on a aircraft carrier, like if you saw the new Top Gun, pretty good movie, by the way. First movie I've seen in a long time that I didn't feel was propaganda. It was fun. It's more like flying a plane and landing it on a tightrope in the middle of a hurricane. That's about what the Fed's doing, and it looks like it's not going to work. What we can see here is what the dilemma is here, and you need to pay attention to what they're saying here. The Fed Reserve Chair Jerome Powell is facing an increasingly grim calculus after yet another hot inflation reading last week. He probably has to push the economy into recession in order to regain control of prices. Okay, let's break that down for a second. First of all, the Fed can't control the prices. The Fed has no control. They can lower rates and increase the money supply. They can increase rates and decrease the money supply. But what happens based off of that is not under their control. They have no granular control over what the price you pay at stake at your local store or what you pay for rent in your town. They have no control over that. But maybe broadly they do. So instead of coming with a scalpel, they may come with a hatchet, potentially. So think about this. He has to push the economy into a recession to regain control of prices. So if prices are out of control, meaning they're going way too high, way too fast, what would you do about that? Remember, all prices are built off of supply and demand. So 2 choices. Choice 1, increase the supply. Now, where we're seeing all the inflation or the price inflation is in food and energy. Those are the 2 areas. But the Fed can't print more food or more energy. So they can't increase the supply of food and energy. So if you can't increase the supply, what's the other option? Decrease the demand. So what does it say here? They can't control prices unless they push the economy into recession. So if we all go broke, I suppose we'll use less of that supply, or there will be less demand. That's one way they can do it. What we can see here is, of course, no surprise, hotter than expected, that the U.S. headline and core inflation both rose more than the forecast, which shouldn't surprise you. The Fed has been behind in everything. There was no inflation. It wasn't a problem. It was transitory. It was going to go away. Of course, it came in hotter than expected. Everything catches them off guard, which is weird because I'm just a guy on YouTube and I've been calling this for 2 years. But you can see that it's way above expectations. So they were hoping for it to be about 8.3, and it came in all the way at 8.6. Now let me just highlight the ridiculousness of this for a second. Even if it would have come in at 8.3, even if it would have dropped to 6.3, what does that really mean? So what most people probably think is that inflation goes down from 8.3 to 6.3. That's great. Hurrah, right? No, that doesn't mean, so at 8.3 or 6.3, that's the rate of prices going up. So prices have gone up crazy, obviously. When inflation comes down from 8.3 to, if it did, 6.3, that doesn't mean prices come down. What it means is that prices are still going up, just a little bit slower. So like, big deal. They went from 8.6, 8.3, 6.3, whatever. Prices are super high. People can't afford them, and they're only going higher. Now, what we can see here is this says it's understandable how fraught politically this is for President Joe Biden's Democratic Party ahead of midterm elections in November. Of course, they don't worry about you and having to fill up your gas tank. All they worry about is the election that's coming out. And we can see here that J.P. Morgan Chase chief economist Bruce Kasman said that I'm even more pessimistic about the opportunity of stabilizing inflation at an acceptable level without inflation. So can they stabilize prices without taking away the demand? Now, what we can see here is what are these expectations? So the Fed has been trying to get in front of this. Of course, they're not in front of it. They're way behind, but they're chasing it, trying to cool down this inflation by bringing the prices down. Again, they can't increase the supply. So the only thing they can do is take away the demand. And they're doing that by raising the rates. Remember, money is created through debt. So when you go to borrow debt, whether that be for a business, a house, a car, a boat, an RV, that money is created into existence. So when interest rates are very low, lots of people borrow. Lots of money is created. When interest rates go up, less people borrow and there's less money being created. So they're trying to raise the interest rates. They've been raising them very dramatically, like 0%, 0.25%, or 0.5% at a time when we have 8.6% inflation. So basically they're doing nothing, a little bit of virtue signaling. Of course, it's burning down the markets. And we can see here, it says that Wall Street floats the idea of a 100 basis point Fed hike as inflation stings. I love this part. It says here, Powell could evoke a Volcker moment to combat inflation. What does that mean? So inflation is the highest it's been in 40 years. But what does that really mean? Okay, that just makes it sound like inflation's been this high multiple times, and it's just high again like it was before. No. It's high like it was 40 years ago, the last time it was this high, which was in the 1980s, which was just after the United States came off the federal gold standard. So for the Austrian economist viewpoint, inflation is increase of the money supply. So when they came off the gold standard, which was holding them back from creating unlimited amounts of money, then they came off the gold standard and they started to increase the money supply or create unlimited amounts. And so we had this massive inflation of the monetary supply, which then pushed prices up crazy. This was a once in a history moment. Gold had been money for 5,000 years. Now we had no restraint, and they created a ton of money. That was a once in history moment. And then it was exaggerated because then over in the Middle East, we had a war going on. We had the oil embargoes. And so then we ran out of oil. Remember, food and energy. So we had an energy problem. So on top of this monetary expansion, then we had this energy crisis on top of it. So they're comparing where we are now to back then, a once in history scenario with extreme examples. But what I love here is Powell could evoke a Volcker moment. So it was President Reagan at the time, and the head of the Federal Reserve was Paul Volcker, and he did something extraordinary. He did something crazy. He raised rates so high that he raised them more than inflation, so that we had a positive interest rate. In order to do that today, we would have to go over the 8.6 that we just printed. So that means they'd have to raise them by 5, 6, 100 points, not 0.5, not 100 points. We're looking at 5, 6, 700 points. So it's hardly a Volcker moment. We can see here that it says that pockets of Wall Street are raising the possibility the Fed could go to extreme lengths on Wednesday in an attempt to control the hottest inflation in 4 decades. The consensus expectation for the U.S. Central Bank's interest rate increases at this week's meeting is a 0.5 percentage point. So most people think a 0.5 percentage point. But because we just got this higher than expected consumer price index data last Friday, it prompted 2 banks, Barclays and Jefferies, to revise their calls for the potential of a 75 basis point. Now, remember, unless we get 700, 800, it doesn't really matter. So 50, 75, what's the point? It hardly seems like anything is going to happen. But what we can see is that they have just been grossly behind on this. I like this part right here, though. So this is something interesting. The topic of inflation has become all-consuming. Amazingly enough, I don't even remember this being the case in the 70s. So remember, back to the 70s. We came off the gold standard. We had massive monetary expansion, and we had an energy crisis because of what happened in the Middle East. And so in the 70s, you would think today we could never have like a fuel shortage in the United States. We could never have fuel rationing. Well, we did in the 70s. 1974, it happened. And I don't remember that, but I went and asked my parents about this last week. And I said, do you remember when gas was rationed in 1974 and you could only get gas on certain days of the week? Like, what was that like? Do you remember it being like really tough, like financially? Was the economy bad? Was it hard to pay for groceries? Like, what do you remember about that? And they saying, I don't know. I mean, I guess remember we can only go to the gas station every couple of days. No, we don't really remember a lot about that. So even as bad as things looked when we work backwards on paper, living through it at the time wasn't that big of a deal. And as you can see what it says right here, it says, amazingly enough, I don't remember that being the case in the 70s where it's all-consuming, where that's the only thing people talk about it. Well, a couple of reasons why. One, obviously we have the internet, we communicate a lot more. But 2, it's way worse. It's way worse. We are seeing the effects of shutting down the economy. It's sort of like you can't, turn an economy off and back on again. And so we're seeing the results of that. It is way worse. That's why we're seeing that. And what we can see here is back to this rate hike. This is the futures market, and we can see what the percentage of people are betting that the rates will be higher. And of course, about 50% of the market thinks that we are going to see greater than 75 basis points, or a 75 basis point hike. So if we've already seen one of the worst drawdowns in the NASDAQ that we've seen, except for the short little blip in March 2020. If you take that out of the equation from the black swan event, then we haven't seen this far of a crash since the great financial crash, the global financial crash. That's where we're at. So if we've already seen that from 2 small little 0.25, 0.5 hikes, what would 0.75. What would 100 points do to the market? Well, we can see that it's breaking a lot of things in the market. And that's the key. What is the point where the market breaks? So what we can see here, and this is interesting, so this is the government bonds, the 10-year bond. And what we can see is they've been operating in this channel since the 80s. Remember, back to the 80s when we had the high inflation. And they've been operating this channel, but what we can see right here is that they've broken out. So this means that bonds are selling off. And this is a bad situation because if you have your money in a 401k or some sort of a pension, most likely your financial advisors put you into some 60-40 split. And what's happened since the 80s and even before that was that the last 100 years was that you would have a stock bond split, equities and bonds. And the reason why you do that is when equities sold off, you'd go to bonds. Bonds were the safe place to be. That was the income. And then you'd go back to equities. And so you'd have some sort of a blend there. But now they're selling off and they're no longer a safe haven. And so what we have here, we can see the S&P 500 down years. So the years when it crashed, going back to 1977, whenever the S&P 500 crashed, the bonds would do good. And we can see that. And so if you had a 60-40 bond portfolio, you held up pretty well. So in 77, you lost 7% in stocks, but you gained 3% in bonds. So you only had a net loss of 0.3. Most of these years, you had barely any loss at all. It held you pretty even. But we're in a different year. We're in a different era. And you can see 2022 at the bottom. The S&P 500 is down 17%. Of course, let's see, we're actually down 22%, so this chart's not totally up to date. So it's down even worse than it was before at the same time that the bond market is crashing. So the stocks and bonds are crashing, and so if you were doing some sort of a 60-40 bond split, you're just down. And so we're in an environment now where there's nowhere to run and there's nowhere to go but down. So when does the Fed pivot? Well, we don't know. Remember, we went back from being financial analysts to now political analysts, and we're trying to guess when they'll pivot. My guess is potentially at the end of the summer. Remember, going back to the article, we looked at President Biden's Democratic Party. All eyes are focused on this midterm election. They don't want to lose the control of the government, and a recession, a double-digit, the worst drop in the NASDAQ since we've seen since the great financial crash. That's not something they want. I'm guessing sometime by the end of the summer, they could pivot. But what do you think? I'd love to get your take because my crystal ball is kind of cloudy. What's yours saying? Leave me a comment and let me know what you think down below. Of course, as always, give me a thumbs up on this video if you like it. If you don't, give me a thumbs down. That's okay. But at least leave me a comment and let me know why. And don't go. Hit the subscribe button so you don't miss any more of these videos, all right? That's what I got for you today. To your success. I'm out. Since you've stayed to the end, I know you like this video, which means you're probably going to really like this video right here and this video right here.